Usually when we talk about a digital security system, for the listener who follows tech, there's this expectation of mathematical permanence.
Right, like a steel vault.
Yeah, exactly. Steel vault. You lock your data inside, the encryption algorithm turns the lock, and you just point to it and say, well, you say, that is mathematically impossible to break in our lifetimes.
Because up until now, it really has been.
Right.
Traditional encryption, like the RSA systems protecting everything from your banking app to classified military communications, it relies on a very specific mathematical trick.
Multiplying those massive prime numbers together.
Exactly. For a classic computer to reverse engineer that to figure out the original numbers, I mean, it would take millions of years.
So the lock is secure simply because the math is too slow to solve.
Yeah, the computer would burn out before it even got close.
But then you step into the world of quantum computing, and suddenly that impenetrable steel vault is, well, it's made of tissue paper.
It really is.
We are looking at a cybersecurity landscape right now that is terrifyingly fragile. So to understand this explosive transition to post-quantum cryptography, today in our deep dive into the source material, we're exploring one specific company navigating this total chaos.
Sealsq.
Right, Sealsq, trading under the ticker symbol LAES. And for you listening, they're carrying a very impressive 8 out of 10 bullish score in the research we're analyzing today.
And Wall Street is paying very close attention here.
Oh, absolutely.
Because quantum computers, they don't calculate sequentially like our laptops do, right? They use quantum bits, or qubits, which can represent multiple states at once.
Which is still mind-bending to me.
It is. But when you apply something called Shor's algorithm to a quantum computer, it can theoretically unravel those prime number locks in a matter of, like, hours.
Hours, not millions of years.
No, the math just doesn't take millions of years anymore. So the foundation of global digital security is suddenly on this massive ticking clock.
Which perfectly explains the forced regulatory shift happening literally right now. We're looking at a White House executive order specifically targeting quantum innovation in the sources.
Right, the 3-year window.
Yeah, it mandates a strict 3-year national preparedness window. But I have a fundamental question about the timing here.
Okay.
Because quantum computers capable of breaking military-grade encryption, they aren't exactly sitting on Best Buy shelves yet.
No, definitely not.
We are still years away from a machine stable enough to execute Shor's algorithm on that kind of scale. So why is the White House demanding preparedness within 3 years?
Well, it comes down to a strategy known in the industry as store now, decrypt later.
Store now, decrypt later. Okay.
Yeah. Hostile state actors, they aren't waiting for the quantum computer to be finished to steal the data.
Oh, wow.
They are actively harvesting vast amounts of encrypted, highly classified data today.
So they're just scraping everything they can get their hands on.
Everything from intelligence databases to, proprietary corporate blueprints, and they're just storing it on massive server farms.
Even though they can't actually read it.
Exactly. They can't read it yet. But the moment a viable quantum computer comes online, they can retroactively unlock all of it.
That is terrifying.
It is. If you wait until the quantum computer is actually built to upgrade your encryption, you have already lost a decade of secrets.
That makes the urgency make total sense. You have to encrypt the data with quantum-resistant locks today so that the data being stolen right now is basically useless tomorrow.
Right.
And it's not just a United States directive either. The research shows the French National Cybersecurity Agency, ANSSI, they've issued this sweeping mandate.
Yeah, the 2030 deadline.
Right, requiring all critical infrastructure operators to procure exclusively post-quantum secure solutions by the year 2030.
And that 2030 deadline in France, it represents what we call a forced market migration.
Forced market migration.
Yeah, this isn't a recommendation. It's not a set of best practices. Governments are taking quantum security, which was previously treated as this academic concern for the distant future.
Like a sci-fi problem.
Right, a sci-fi problem, and turning it into an immediate, non-negotiable procurement requirement.
So if you want the contract, you have to have the tech.
If you are a vendor providing hardware or software to a European power grid, or a water treatment plant, or a telecom network, and you aren't quantum secure by that deadline, you are legally locked out of the market entirely.
Wow.
The infrastructure budgets are being forcefully unlocked by the government.
It reminds me of the frenzy around the Y2K bug in the late 90s.
Oh, yeah, definitely.
Where every corporation on Earth suddenly realized their legacy systems might crash when the calendar flipped, and they just had to spend billions upgrading instantly.
But the difference here is the penalty.
Right. Because instead of a computer accidentally showing the year 1900 and, like, crashing a supply chain spreadsheet, failing to upgrade to post-quantum cryptography is like handing international data thieves the universal master keys to every single bank vault.
And every state secret on Earth.
The stakes are infinitely higher, but let me stop and look at the reality on the ground for a second.
Sure.
Because mandates are great for generating headlines, but are companies actually signing purchase orders for these solutions yet? Or is the sector still just, trading on government white papers and theoretical panic?
Well, a significant portion of the quantum sector is indeed stuck in the theoretical phase.
Just selling promises?
Selling promises of future capabilities, yeah.
Yeah.
But Sealsq stands out in this research specifically because they have built a tangible physical moat.
Meaning they're actually shipping physical hardware today.
Exactly.
Yeah, the pipeline numbers in the sources are striking. They list over 150 customers and prospects, with more than 30 actively integrating Sealsq's technology into their systems right now.
Which is huge for this industry.
It is, and the anchor of this seems to be their QS7001 post-quantum secure element. And again, this isn't a prototype sitting in a lab somewhere. It is actively shipping to clients.
Right.
But the research heavily emphasizes that this chip holds a NIST validation. Specifically, it's SP890B, certificate number E333.
Yes.
And we need to explain what that actually means because, for the listener, a certificate number alone doesn't tell us why the tech actually matters.
Well, NIST is the National Institute of Standards and Technology. In the world of cryptography, they are basically the supreme authority.
Okay.
But that specific validation, the 890B, it is crucial because it validates their entropy source.
Entropy.
Yeah, entropy in cryptography refers to true randomness.
Not just computer-generated randomness.
Right, because if you generate a password using a software algorithm, a supercomputer can eventually identify the pattern in that algorithm and predict the password.
So it's only pseudo-random.
Exactly. It's pseudo-random. To beat a quantum computer, you need true, unpredictable randomness that isn't based on an equation at all.
You need something happening in the physical world.
Yes. Sealsq's secure element uses physical characteristics like microscopic thermal noise on the silicon chip itself to generate that randomness.
Oh, wow. Literally measuring heat fluctuations on the chip.
Exactly. The NIST validation essentially proves that Sealsq's hardware generates true, unguessable entropy.
Then without
that specific validation, you simply cannot sell your product to government agencies. It acts like a highly restricted diplomatic passport. Without it, you don't even get past the front gate of the procurement process.
So they have what the research calls a quantum vertical stack, grounded in a physical hardware root of trust. The silicon itself is the shield.
Not just a software patch that could be exploited later.
Right. And there is a geographical layer to this moat that caught my attention too. Sealsq is headquartered in Geneva, Switzerland, and they have established operational anchors in Spain's quantum corridor.
Which is a massive strategic advantage when you consider the European market.
Because of supply chain sovereignty?
Exactly. It has become a paramount concern for the European Union. They watch the global chip shortages, they see the rising geopolitical tensions.
And they don't want to be reliant on outside powers.
Right. There's a very strong desire not to rely entirely on Silicon Valley or Asian foundries for their most sensitive national security infrastructure.
Especially considering that strict French ANSSI mandate we discussed earlier.
Exactly.
If France is forcing its critical infrastructure to go quantum secure, they ideally want a European-based supplier providing the actual silicon.
They want it kept in-house, essentially.
Yeah, so Sealsq positioning themselves as a trusted, neutral, non-U.S. alternative, it allows them to bypass the sovereignty concerns that might automatically disqualify a major American defense contractor from winning those exact same European bids.
It basically creates a captive market for them.
But, building and scaling physical hardware to meet the demand of a forced global migration is incredibly difficult.
Oh, it's punishingly capital intensive.
Right. You are talking about semiconductor fabrication, maintaining physical supply chains, research and development for microscopic silicon structures. It costs an absolute fortune.
It really does.
If they are scaling up to supply a global transition, how are they paying for it without bleeding the cash reserves of their core legacy business entirely dry?
Well, to manage that immense capital requirement, Sealsq is utilizing a highly unorthodox corporate structure.
Okay, the SPAC.
Yeah, they are financially engineering a spin-out of their entire quantum asset portfolio into a special purpose vehicle, or SPV, named Quantissimo.
Quantissimo. And the mechanism they're using to take this vehicle public is a non-binding letter of intent with a SPAC, a special purpose acquisition company.
Called Good Capital 8.
Right, Gig Capital 8. The financial roadmap detailed in the sources here is just staggering. They are targeting an initial pre-money valuation of $575 million for this new Quantissimo entity.
Which is a massive starting point.
Huge. And their stated objective is to scale that valuation up to $2 billion through a series of up to 5 consolidated acquisitions.
Right.
On top of that, this new SPAC vehicle is slated to fund their Quantum Special Orbital Cloud program.
Which is fascinating.
It is. It literally includes launching a dedicated payload on a SpaceX Falcon 9 rocket scheduled for the fourth quarter of 2026.
The sheer scale of the ambition is notable, right? But the underlying financial logic here is actually about capital preservation.
How so?
By isolating the incredibly expensive quantum research, the future mergers and acquisitions, and, the literal rocket launches into this new SPAC vehicle, Sealsq effectively shields its existing revenue-generating semiconductor business from massive dilution.
Ah, okay. It makes me think of like a massively successful established rock band that decides to fund a highly experimental, incredibly expensive avant-garde solo project.
That's a great analogy.
Yeah, if they
Yeah.
use the band's main bank account to fund it and the album flops, the whole band goes bankrupt.
Right.
So instead, they set up an entirely separate record label with outside investors just to fund the solo project. If it goes multi-platinum, the parent company reaps the rewards. If it struggles, the main band is insulated and can still go on tour and play their classic hits.
That is an incredibly accurate way to view an SPV spin-out. They are taking their high-risk, high-reward quantum portfolio, their Seal quantum assets, and unlocking its hidden value by giving it a distinct valuation in the public markets.
Entirely walled off from the parent company's balance sheet.
Exactly.
I understand the defensive logic, I really do, but I have to call out the sheer speculation built into this roadmap.
Oh, absolutely.
I mean, planning to scale a brand new entity from a $575 million valuation to $2 billion by relying on 5 completely unconfirmed acquisitions is a monumental leap of faith.
It's a huge task.
Because the listener should understand that successfully integrating just one acquired company is notoriously difficult. You've got culture clashes, redundant tech, misaligned sales teams.
Yeah.
Assuming they can pull off 5 perfect corporate integrations to hit that $2 billion target is the definition of forward-looking execution risk.
It is highly speculative. You have this fascinating dichotomy at play here. On one side, Sealsq is shipping tangible, NIST-validated hardware today, securing active revenue streams.
Right.
But on the other side, they're engaging in highly complex, speculative financial maneuvering to fund their next decade of growth.
And how the broader stock market digests that mix of the highly tangible and the highly theoretical is critical for us to understand.
Definitely.
Let's look at the market dynamics because, you can't analyze a single stock without looking at the gravitational pull of its wider industry.
Right. The broader quantum sector has been taking an absolute beating recently.
A bloodbath. The research highlights a 20% sector-wide pullback. We saw major peers in the space, companies like IonQ and D-Wave, go through a pivotal earnings week where the market aggressively tested their lofty valuations and they just got punished.
This is a classic case of multiple compression.
Can you break that down?
Sure. When a sector trades primarily on future promises, investors are willing to pay a massive premium, a high multiple on the stock price relative to its actual earnings.
Because they're buying the dream.
Exactly.
Huh.
But the moment those promises take longer to materialize or interest rates rise, investors lose their appetite for theory. They demand to see actual revenue.
And when they can't produce it.
The premium evaporates, the multiples compress, and the entire sector's valuation gets dragged down.
Yet amidst that 20% sector bleed, Sealsq demonstrated surprising resilience.
They really did.
I mean, they did take a sharp one-day hit of 12.33%. You can never completely escape the gravity of a sector sell-off, but over a 30-day period, the stock actually posted a positive return of 9.59%.
Which is very telling.
The sources point to an independent analyst upgrade from June 9, 2026, which cited that the company is actually undervalued, noting it was trading at roughly 4 times its projected 2027 enterprise value to sales ratio.
And that metric, the EV to sales ratio, is key here. It measures the total price tag of the company against the actual revenue it brings in.
Okay.
A ratio of 4 is incredibly lean for a high-growth tech company. Compared to those pre-revenue quantum peers that were trading at massive speculative multiples, Sealsq looks fundamentally cheap to institutional investors.
And that explains the technical sentiment the research outlines. If a stock takes a sudden 12% hit on sector weakness, but still manages to close out the month up nearly 10%, the chart is drawing a pattern of higher lows.
Right.
That tells us that whenever the stock experiences a significant drawdown, institutional money is stepping in and aggressively buying the dip.
Accumulation.
Exactly. And the research specifically notes that when the Quantissimo SPAC spinout was formally announced, the stock experienced its best week in over a month. That is a glaring signal of institutional accumulation ahead of these major catalysts.
Smart money is positioning itself for the long game. But, relative strength in a bear market can only carry a stock so far.
Right.
If the fundamental thesis of the wider quantum sector continues to erode, Sealsq will eventually face immense pressure.
Which brings us to the formal risk assessment. We need to look at the dark clouds on the horizon because the sources outline two primary execution risks that any investor or observer needs to weigh heavily.
Okay.
Risk number one is exactly what you just alluded to: sector valuation compression.
Right.
Sealsq could execute its business plan perfectly. They could hit every milestone, ship every chip, and still suffer massive multiple compression simply because the broader market decides that quantum companies as a category just aren't worth the premium anymore.
Yeah, if peers like IonQ completely fail to show commercial progress, the entire asset class gets penalized.
It doesn't matter how solid your house is, if the entire neighborhood is sinking into a sinkhole, your property value is still going to plummet.
That's exactly it.
And risk number two is heavily tied to the financial engineering we discussed: SPAC execution and dilution. That letter of intent with gig capital 8 is non-binding.
Meaning the deal could fall apart at any time during the due diligence phase before the final closing.
Right. And even if it does close successfully, there is the mathematical reality of funding those 5 planned acquisitions.
Yeah, that's a big hurdle.
If Quantissimo has to issue massive amounts of new equity to buy those companies and reach that $2 billion valuation, the current shareholders face heavy dilution. The overall pie might get bigger, but the shareholders' individual slices get dramatically smaller.
The structural and financial risks are heavy. There's no getting around it.
So how does the source material weigh those risks against the company's fundamentals?
Well, the primary mitigation emphasized in the research is that tangible commercial anchor we talked about.
The actual hardware shipments?
Yes. Pre-revenue companies trading entirely on white papers face pure valuation wipeouts when the market turns. They have no floor.
Just free fall.
Exactly. But Sealsq has the QS7001 product shipping today. They have the 30 active integrations into critical infrastructure. That physical revenue stream acts as a fundamental floor, providing a level of protection against the theoretical wipeouts seen elsewhere in the sector.
They have actual cash flow to fall back on, but testing this thesis requires immense patience from the market. I mean, we are looking at the first quarter of 2027 for the expected close of the SPAC transaction.
Which is a long time.
In modern market terms, that is an eternity. You have to hold your breath for a multi-year investment thesis to play out.
You do, but the interim period is packed with highly visible milestones.
Like what?
You have the SpaceX orbital cloud launch scheduled for the fourth quarter of 2026. You have the ongoing integration of their hardware as governments aggressively race toward that 2030 French ANSSI deadline and, the 3-year White House window.
The mandates.
Right. The secular tailwinds, the regulatory forces demanding this technology, immediately they are blowing with absolute hurricane force.
Let's summarize the asymmetric landscape we've explored today. Sealsq presents a highly specific multi-year narrative. It is entirely driven by immediate, legally binding regulatory mandates that demand post-quantum security right now. They aren't waiting for the software market to mature. They are shipping tangible, physical hardware today, secured by that vital NIST entropy validation.
That physical root of trust.
Exactly. And they are attempting to shield their core legacy business through an aggressive SPAC spinout, all while targeting massive future catalysts like an orbital launch.
It is a profound intersection of deep tech execution and complex capital allocation. They are offering a physical solution to a problem that global governments have declared legally non-negotiable.
But before we wrap up this deep dive, I want to leave you, the listener, with a final thought to mull over. Something that builds on Sealsq's European footprint, but pushes the implications a step further. Think about the concept of cryptographic sovereignty.
The idea that nations must own the foundation of their own security.
Exactly. We're entering an era where quantum computing could theoretically break any secrets stored on conventional servers.
Hmm.
If the stakes are that high, and countries eventually refuse to trust any foreign hardware to run their most critical post-quantum infrastructure. I mean, if the United States refuses to buy European chips, and Europe refuses to buy American chips, and nobody trusts hardware fabricated in Asia, how will that reshape global technology trade?
It would fracture everything.
Are we heading toward a future where the internet and the physical hardware that runs it completely fractures into isolated, highly protected, sovereign quantum zones?
It really changes the entire paradigm of a globally connected world. The master keys to the digital economy are being forged right now, and suddenly, no one trusts the blacksmith unless they live inside their own borders.
The global vault doors are wide open, and the race to build the new quantum locks is going to fundamentally change the landscape of geopolitical power. Thank you for joining us on this deep dive into the source material. Keep questioning the headlines, keep looking for the underlying mechanics driving these rapid technological shifts, and we'll see you next time as we unpack the next big transition.